You have a great project. You have done your market research. You have even built a financial model. And then you submit your business plan to a funder, and you hear nothing.
No response, not even a rejection.
Because 80% of African project submissions are screened out before a funder even reads past the first page. Not because the project is bad, because the document is wrong.
So the problem is not the project, it is the packaging.
In infrastructure finance, the document is the product. Welcome to Episode 2. Today, we are going to teach you exactly how to write a document that gets read, gets reviewed, and gets funded.
Let us start with something a lot of developers get wrong. What is the difference between a business plan and an information memorandum?
A business plan is written for internal management. It describes how you are going to run a business. An information memorandum, or IM, is written for external capital providers. It describes how their money will be deployed, protected, and returned.
Two completely different audiences.
Two completely different documents. A business plan says, here is our idea and our plan. An IM says, here is a structured, de-risked transaction, and here is the evidence that your capital is safe and your return is achievable.
And funders want the IM.
DFIs, private equity funds, and commercial banks have credit committees. Those committees do not read business plans. They read investment memoranda, and they use a checklist.
Before you write a full IM, where do you start?
You start with a concept note, 1 to 2 pages. This is your first contact document. Its job is not to close a deal. It is to open a conversation.
What goes in a concept note?
5 elements. First, the problem. What market gap does this project address? Second, the solution. What is the project? What is its capacity? And what technology does it use? Third, the market. Who buys the output? And is that demand evidenced or contracted? Fourth, the team. Who is the sponsor and what have they built before? Fifth, the ask. How much capital, in what form, and for what purpose?
That is the whole story in 2 pages.
If you cannot tell the story in 2 pages, you do not yet understand your own project well enough to raise capital for it. Clarity of thinking is a credit signal.
And after the concept note?
Only after a funder responds to the concept note with interest do you invest in a full information memorandum. Never spend money on a full IM before you have validated the interest. That sequence has saved our clients years of wasted effort.
Take us through the full information memorandum. What are the 7 components?
Component 1, the executive summary. This is the most important section in the entire document. It must be self-contained. A funder must be able to understand the full investment case by reading only the executive summary. If they like what they see, they read on. If they do not, the rest is irrelevant.
What specifically goes into the executive summary?
The project snapshot, name, sector, location, capacity, development stage, the capital structure, total project cost, debt to equity split, preferred currency, the revenue thesis, who pays, how much, on what contractual basis, the return profile, target IRR, payback period, DSCR summary, sponsor credentials, and the ask, how much you are seeking, in what instrument.
Component 2.
Component 2, market analysis. This section answers the single most important question a funder asks. Is there a real, provable, sustainable market for this project's output? You need total addressable market data with credible sources. Demand evidence, ideally signed offtake agreements, but at minimum verifiable data. Competitive analysis, pricing and tariff benchmarks, and a clear view of the macro drivers supporting demand growth.
So not just saying the market is large.
Never assume. Prove. Every claim in the market analysis section must be referenced to a source, AFDB sector reports, IEA data, World Bank country statistics, government census data. If you cannot source it, you cannot claim it.
Component 3.
Component 3 technical plan. DFIs lend against assets and cash flows, not intentions. The technical plan shows them exactly what is being built, Where, with what technology, by whom, and on what timeline.
What are the critical elements?
Site details and title documentation, technology selection, and why this technology is proven for this context. The EPC contractor profile and contract structure. A phased construction timeline with clear milestones and commissioning date. The operations and maintenance plan, and the environmental and social impact assessment, completed to IFC performance standards.
The ESIA is always non-negotiable for DFIs.
Non-negotiable. And increasingly, impact investors and commercial banks also require it. The IFC's 8 performance standards are the global benchmark. If your ESIA does not reference them, it will be flagged immediately.
Component 4, the financial model.
Component 4 is the heart of the document. The financial model tells the lender whether their money is safe, when it will be repaid, and what return the equity investor will achieve. It must do 4 things: model the revenue, model the costs, calculate the DSCR, and run sensitivity analysis.
Let us spend a moment on the DSCR because this comes up in every deal.
The debt service coverage ratio equals cash available for debt service, divided by the annual debt service obligation. The DFI minimum is 1.3 times under base case. That means for every $1 of debt repayment, your project generates $1.30 in cash flow.
And the sensitivity analysis?
You model at least 3 scenarios. Base case, your most likely outcome. Downside, a revenue reduction of 20 to 30%, cost increase of 15%. Stress, worst plausible combination, maximum cost overruns, minimum revenue, adverse FX movement. If your DSCR falls below 1.3 in the downside case, you have a structural problem that must be solved before you submit.
What about the return metrics for equity investors?
Target equity, IRR for African infrastructure, is typically 15 to 25%, depending on sector and jurisdiction risk. Your model must show the IRR clearly, and it must be justified by the revenue and cost assumptions, not reverse-engineered from a target number. Funders see through reverse-engineered models immediately.
Component 5.
Component 5, management and sponsor profile. In African project finance, the sponsor is as important as the project itself. A funder is not just investing in a cash flow model, they are investing in the people who will execute it.
What does a strong sponsor profile look like?
A verifiable track record of prior projects developed, financed, and operated in the same sector. Senior management CVs that demonstrate technical and commercial competence. Clear equity commitment. The sponsor must have skin in the game, co-investor or strategic partner credentials, and a governance structure, how the SPV board is composed, how decisions are made, how performance is reported.
Component 6.
Component 6, legal and regulatory framework. This is where more deals die at due diligence than anywhere else. Incomplete land title, expired environmental permits, offtake counterparties who are insolvent, SPVs that are not properly incorporated.
What must be documented?
Registered land title, no encumbrances, no disputes, community rights cleared. All construction, environmental, and sector-specific permits. The SPV's incorporation documents, shareholding structure, and articles. The signed offtake or concession agreement with an analysis of the counterparty's creditworthiness. ESIA regulatory approval. And a dispute resolution clause. International arbitration, preferably ITCID or ICC, is the standard for DFI-backed deals.
And Component 7.
Component 7, risk matrix and mitigation plan. Every funder knows that every project has risks. They are not looking for a risk-free project. Those do not exist in Africa or anywhere else. They are looking for a sponsor who has identified every major risk and has a credible plan to mitigate each one.
What are the standard risk categories?
Political and regulatory risk, mitigated by political risk insurance and sovereign guarantees. Currency and foreign exchange risk, mitigated by USD-denominated revenue structures or hedging instruments. Construction delay, mitigated by fixed-price EPC contracts with delay-liquidated damages. Offtake default, mitigated by selecting creditworthy counterparties and requiring bank guarantees. Environmental and social risk, mitigated by IFC performance standards compliance and ongoing community engagement, and refinancing risk, mitigated by tenor matching and maintaining a refinancing reserve,
So every risk gets a mitigation.
and a residual risk rating. After the mitigation is applied, what is the remaining risk? Low, medium, or high? That residual profile is what the credit committee uses to price the transaction.
How should project developers think about capital structure? How much debt versus equity?
African infrastructure deals typically target a 70-30 leverage ratio, 70% debt, 30% equity. The debt sits in layers. Senior debt from DFIs or commercial banks, typically 60 to 70% of total project cost. Mezzanine or subordinated debt can bridge a gap if needed, usually 5 to 15%. Equity from the sponsor and co-investors covers the remainder, and the DFI minimum equity contribution requirement is typically 20%.
So the sponsor must put in at least 20% equity.
Most DFIs will not lend if the sponsor is contributing less than 20% equity. It is a commitment signal. If you are not willing to put 20 cents of your own capital at risk for every dollar of theirs, the answer is no.
What are the most common mistakes you see in African project IMs? The ones that cause immediate rejection?
Number 1. Projecting revenue without contractual backing. Saying the project will sell 10 megawatt hours per day without showing a signed power purchase agreement. That is not a financial model. That is a wish list.
Number 2.
Unrealistic CapEx estimates. Missing the 10% contingency buffer that all credible construction budgets require. Ignoring foreign exchange exposure on imported equipment. CapEx underestimates blow-up DSCR, and credit committees know it.
Number 3.
A DSCR below 1.3 in the base case. This is a hard stop. The lender cannot size a debt facility against a project that does not generate sufficient coverage. The fix is to either increase revenue by securing stronger offtake terms or reduce costs. You cannot paper over a DSCR problem with narrative.
Number 4.
An incomplete ESIA. Missing IFC performance standards baseline data. Missing community consultation records. Missing regulator sign-off. This is one of the most common causes of DFI due diligence failure, and it costs months to fix.
Number 5.
No exit strategy. Equity investors need to know how they get their money back, in how many years, at what return, through what liquidity mechanism, trade sale, refinancing, IPO, or government buyback. If there is no exit, there is no investment.
And number 6.
An unqualified management team, CVs that show no prior project development experience in this sector. A developer who has never brought a similar project to financial close. Funders are not training academies. They need evidence that this team has done it before.
Once you submit your IM, what happens on the funder's side?
In the first 1 to 2 weeks, the IM goes through an initial screening. A desk review for completeness. Are all 7 components present? Does the project fit the funder's sector mandate and minimum ticket size? Does the risk profile fall within their appetite? Projects that pass the screen move to preliminary due diligence.
How long does the full process take?
From submission to financial close, a well-structured project typically takes 16 to 24 weeks with an active funder. Projects with documentation gaps can take 12 to 18 months or never close at all. The quality of your IM directly determines the speed of the process.
For developers watching this, if you need help building a bankable IM, what support is available from AIB Corp Ltd?
AIB Corp Ltd provides end-to-end documentation support for African infrastructure projects. Full Information Memorandum preparation to DFI standard. All 7 components. Financial model build. DSCR, IRR, NPV, and sensitivity analysis. Risk matrix and mitigation planning. And funder targeting. Matching your project profile to the right development finance institution, private equity fund, or commercial bank. Our fees are structured on a retainer and success fee basis, aligned to African project budgets. We offer a confidential initial consultation for qualifying projects. Visit u.aibcorpltd.com or reach us directly at the address on screen.
The document is the project in the eyes of the funder. Build it to the right standard.
That is episode 2. If you now understand the difference between a business plan and a bankable IM, and you know what all 7 components must contain, then you are ahead of 80% of developers submitting to funders right now.
Subscribe now so you do not miss episode 3, the top 5 African infrastructure sectors to develop in 2026, with DFI data and sector-by-sector bankability analysis.
Subscribe. Share this with a project developer who is preparing a submission. Visit u.aibecorpltd.com and leave a comment. What sector are you developing in? And what stage is your documentation at? We read every one.